Hello and welcome to Weekend Investing Daily Bytes. We're shooting episode 237. Today we're going to talk about the power of gold as a hedge to protect against happenings in your own local currency. And we'll take the example of the Japanese markets over the last 4 decades. More of that later, but first let's take a look at the market today. So market was very strong, opened gap up on the back of very good global cues. Asian market was up and Nasdaq seems to have made some intermediate bottom, although it could be a bear rally, but a fierce one at that right now. Real estate stocks and IT stocks were leading the front, with many banks, infrastructure stocks and auto stocks also making new highs. For instance, Mahindra made a new high. TVS was going fast. iShares, Maruti, all of them were looking robust. Nifty, as a result of this, ended at plus 1.89%, and most of the sectors that we track were in the green for the day. So this has erased most of the losses in the last 1 week or so from all sectors, and some damage control is being done for the monthly stats also. In terms of the other indices, Nifty Next 50 was up 2.3%, mid and small cap also up similarly, small caps also up similarly. Everything was up between 2 and 2.5%, so very robust sort of a bounce that came today. In terms of weekend investing strategies, some really great bounces in MI20, 3.3%, NNF10, 3.2%, MI35, 2.67%, MI ATH2, 2.6%, and so on and so forth. And some of the strategies where cash is very high, they of course were lagging, but that's how the nature of the absolute momentum strategies are. Relative momentum strategies fall more along with the indices, but rise rapidly also. Absolute strategies usually go to cash and fall less in a deeper crisis, but then they have a lag in coming back up. So both have their own individual characteristics. In terms of top gainers in the CNX 500 universe, Zomato was up 15%, Gujarat Ambuja Exports up 12%, Dixon Technologies up 11%, 3M and Affle also up 10 to 11%. So many of these stocks had got battered down in the previous fall, and there was a huge bounce in many of these stocks. Hycal was down still at minus 7%. Dr. Path Labs has dramatically come down from its top, today down 5%. Easy Trip also down very sharply in the last 1 week, minus 4.5%. Thyrocare minus 3%. Tata Elxsi was a surprise, where IT stocks were very robust and strong today, whereas Tata Elxsi gave away some ground and closed minus 3%. So coming back to the topic, so this is a near 40-year chart of the Japanese market. So this orange line is the Nikkei index. You can see that Nikkei index went up like 4x in these 5 years, from mid 80s till about 1990, and then it dramatically collapsed from the top down to about 75-80% kind of drawdown, and then only very recently in 2012, or maybe you can say in 2009, it made a bottom and has gradually crept back up. The blue line is the performance of gold in Japanese yen. What is observable here is that Japanese yen, the USD JPY, was about 250 in mid 80s, so 250 yen per dollar, and that collapsed to almost, I think, somewhere close to 70 yen to a dollar. So Japanese yen kept getting very strong along with this market, and once the market was bust, then the currency sort of bottomed and it started to soften again, or rather should I say the Japanese yen topped out near the 70s and it started to fall back again, and now it is near 127 or so. So what has happened is that the currency has moved all over the place, from 250 yen to a dollar. down to nearly 70 odd yen to a dollar, and then now at 130 yen to a dollar. So the local currency has caused a major change in asset pricing for the locals who are wanting to hedge against their global purchasing power. So anybody, let's say somebody who has bought the equity market, and it will be very difficult to sort of assume that everybody is bought at this point before the rally. So let's say most people bought middle of the rally. So after 40 years they are sitting nowhere. I mean, there is no return virtually even after 40 years. However, had they had a hedge of gold while the market was going up, they would have lost money in gold as the currency was appreciating. But once the currency topped out and started to depreciate, the returns in gold would have majorly hedged the losses in equity. So much so that even if somebody had bought at the very beginning of this rally here, they would have made the same returns in terms of gold versus equity. Whereas if somebody had bought it somewhere in the middle here and bought the gold hedge here, they would have actually made a positive CAGR over the period. So it is always beneficial to hold non-local currency assets also. It could be in form of overseas stocks, could be in form of gold, because these are assets which are not denominated in the local currency. They are globally priced, so as to say. And if somebody had seen just the last 2 decades, then in the last 2 decades gold in Japanese yen is up something like 7-8 times, whereas the equity market is up maybe like 40-50% in the last 20 years. So depending upon the phase of each decade, the results could be very, very different, but over a very long period we've seen that the hedge really works very well. So that's why I also continuously advocate that you must have exposure to non-rupee based assets, and that will give you some solace if and when any crisis comes to our shores. I hope we don't see that day, but it is always, and this is like an insurance, right? I mean, why do we buy medical insurance? Why do we buy car insurance? Not just because it is mandatory, the car insurance, but because we want to cover ourselves. We want to cover the risk of a sudden damage, and that's what you can do by diversifying your asset classes. Another sort of insight here was on Jubilant FoodWorks. So a new CEO has been announced, and the last 3-4 days have been very, very sharp pullback after having fallen from the last year and a half. So from 440 it has leapt suddenly to 566. So my sense is that some of this news was already getting built in, and some of it of course was completed today, and we may see a new leg on this stock. Usually when new energy comes in form of new CEO, new team, we can see that some of the stocks will get repriced, and that's what we are seeing here. Another insight was on Brent oil. So what have we seen here after all this talk about slowing down of inflation and increase of interest rates, and that will slow down the demand. But what is the proof of the pudding? Proof of the pudding here is that oil has not dropped. Oil has virtually corrected from the highest point of 137, 138 it reached to about 100, and now it is starting to go back up again. So even on a weekly basis, at the end of this week, if we are staying near about 120, it will be the highest weekly close in the last decade. So that still calls for very, very strong oil prices, and that means that nothing has got abated in terms of inflation or the high energy prices that we're talking about. So while we have damaged the market by increasing the interest rates, the inflation so far has not gotten affected or impacted, at least from an oil price perspective basis. So the danger still lurks out there. I don't think the central banks have their hands around this yet in terms of controlling it. Uh, Another insight was on our product NNF10, which is a 10 stock portfolio, monthly rebalanced based on the Nifty Junior or Nifty Next 50 as it is called, the index. And the journey of the back tests and the actual run has been captured in this image. And we see that there are phases of outperformance where the strategy will outperform by a big way, then it may give up some of the gains and underperform. So in this fall here in 2015-16 demonetization time, it underperformed the Nifty Next 50 drop. Then in the rally it again outperformed the underlying index. Then in the fall this time in 1920 it outperformed the fall as well. Then in this upward phase, it again outperformed the underlying index, but this current fall that we had, and this data is till Thursday, I think. This current fall, it has underperformed the index. So there are periods of outperformance, there are periods of underperformance, but overall so far, we are able to see a better performance than the underlying benchmark, which is the ultimate aim of any such strategy. So you should stay the course, whether you're following this strategy or your own strategy. There will be periods where you will not be able to, outperform all the time. And that's okay, because, the composition of your stocks versus the composition of the index, they will have some lead and lag at times. But it is essentially in medium to long term, if you are able to outperform the benchmark, that's good enough. That's the aim of the actually underlying strategy. So this is all I had for today's daily bite. Thank you so much for watching. I hope you are sharing it with people who you think can use it. And please do subscribe and like the daily bite effort. And I'll see you in another video. Bye.